Buying or renovating property in 2026 isn't just expensive, it is completely unforgiving. Right now, thousands of first-time buyers and renovators are about to sign contracts that will trap them financially for the next decade. Not because they are reckless, but because they are walking into this market completely unprepared. Three massive traps have collided at once. First, while advertised mortgage rates look attractive under 4%, banks are secretly stress-testing your income at rates as high as 7%. If your budget can't survive that simulated shock, your application fails. Second, elevated material and labor costs mean the wrong fix-upper will destroy your savings before you even finish the kitchen. And third, aggressive new EPC energy efficiency mandates are making UN retrofitted properties practically UN sellable and UN rentable. One wrong purchase, one miscalculated renovation, and your deposit disappears into structural repairs, insulation upgrades, and rewiring before you've created a single pound of real equity. Before we reveal the exact blueprint to protect your money, hit that subscribe button right now, like this video, and share it with anyone looking to buy this year. Navigating this market without a clear strategy will cost you thousands. Subscribing to the Wealth Ledger ensures you stay ahead of these financial traps every single week. Let's break down the strategy. For first-time buyers, the biggest mistake is chasing maximum borrowing capacity instead of maximum financial flexibility. Just because a lender approves you for a higher limit does not mean you should take it. Always leave room in your monthly cash flow for rising council tax, building insurance, and emergency maintenance. Next, rethink your location strategy. Premium city center postcodes are severely overpriced, offering minimal room for capital growth. Smart buyers in 2026 are targeting emerging regional towns and commuter belts with infrastructure upgrades, new employer investment, and strong local economies. That is where real long-term value lives. Finally, never treat the asking price as gospel. Properties sitting on the market for over 60 days are ripe for aggressive negotiation. In a price-sensitive market, securing even a 5 to 10% discount below asking price instantly boosts your long-term returns. Now, if you are a renovator, this is where fortunes are made or lost. Older homes look like bargain investments on paper, but the real trap is the hidden retrofit cost required to meet 2026 EPC targets and modern building regulations. Single glazing, outdated electrics, damp, and inefficient heating are no longer minor cosmetic issues, they are massive financial liabilities. Before placing an offer on any fix-upper, get an independent retrofit estimate in writing. When planning your budget, focus strictly on high-ROI projects like loft conversions and extensions that add physical square footage. Avoid burning capital on luxury cosmetic finishes that don't increase the property's baseline value. And above all, lock away a non-negotiable 15 to 20% contingency fund. In today's volatile pricing environment, going into a project without a cash buffer is financial suicide. Before you make any move in 2026, follow these three non-negotiable rules. Rule 1. Calculate the total cost of ownership, including legal fees, stamp duty, survey fees, and emergency reserves, not just the deposit. Rule 2. Always pay for a full independent structural survey. Spending a few £100s on a professional survey will save you tens of thousands in hidden defects later. Rule 3. Always build multiple exit strategies. Ask yourself, if property prices stall, can I comfortably live here or rent it out to cover all costs? If a deal relies on one perfect scenario to make money, walk away. The 2026 property market does not reward optimism, it rewards cold, hard numbers. Approach every purchase like a ruthless financial audit, protect your cash reserves, and buy for long-term value. If this guide gave you clarity, make sure to subscribe to the Wealth Ledger for more direct, no-nonsense financial strategies. Thanks for listening, and I will see you in the next episode.